Okay, so I was gonna wait to do this video, but I came across a "Did You Know" from Chris Hogan on YouTube. Now, he's got a huge subscriber base, which should tell you he must offer some solid information. I mean, he's got over 220,000 subscribers, and I just have like, what, 50? So what do I know, right? Now, I don't watch his channel, but I'm gonna have to disagree with his video just put out this year on November 9th, titled "The 4 Worst Home Mortgages on the Planet." Hey, this is Jed with Manual Mortgage. So this is a quick video in response to Chris Hogan's video, "The 4 Worst Loans on the Planet." Now, one of the loans is an FHA loan, and I'm gonna make this one quick so I can get to the real reason I did this video. So I'm gonna briefly touch on FHA. It does have, I agree with him, it does have additional upfront costs, such as upfront MIP that is typically financed into the loan, and it also has MIP, PMI, call it whatever you want, you have to pay it. Now, unless you put down at least 10%, that monthly MI or MIP is going to be there for the life of the loan. It never comes off. Now, if you put more than 10% down, it'll be automatically be removed after 11 years. Now, PMI isn't a death sentence. Putting down 20% is probably closer to one. The PMI actually allows a person to work with what they have and purchase a home with only 3.5% down payment. Now, the goal on an FHA loan is to be able to purchase the home and put a plan together on refinancing it out of it between 2 to 5 years. Now, really, as soon as they're able to refinance out of it into a conventional loan and remove the PMI. Here's where the problem might be. There wasn't a plan to refinance you or the person with an FHA loan out of it. With rates so low, and pair that up with removing the monthly MIP on an FHA loan, you're most likely going to be in a better position than when you purchased it. Now, comment below or send me a text if you want me to show you how to refinance out of a FHA loan and without MIP or PMI. Now, for the real reason I did this video, one of the other worst loans that on the planet that Chris Hogan mentions is a VA loan. Mind you, there are 6 loans that I can actually think of that are typically used to purchase a home. And he's got 4 of them on this list, but there actually should be 5 because he actually leaves off USDA simply because it has a funding fee. Simply because it has a funding fee at the time of purchase, you could also owe more than the purchase price. And this is the reason that Chris Hogan mentions the VA loan is the worst option available for their service. Now, at the time of purchase, you might owe more than you purchased it for, and if Chris actually finished this statement, you'll forget everything you said before the but. Now, let's debunk this information and give you the facts on why the VA loan is the best option available. There might be a funding fee when that'll cause you to owe more than when you purchase the home. However, if you receive a VA disability, you are exempt from this funding fee. So this statement is not 100% true. And here are the rest of the reasons that debunk this information and try to keep up. 0 down payment, 0 monthly mortgage insurance, aka monthly PMI. There's also a lower credit score. There are also lower credit score requirements, and higher debt ratios are allowed for qualifying. A monthly payment does not need to be calculated for any type of collection with any size balance, meaning you can omit all collections. A monthly payment doesn't need to be calculated or included against the debt ratio on any student loans that are deferred for more than 12 months after the loan is closed. Now, all those seller contributions need to be negotiated. The VA allows a maximum of 4% of the sales price. And that's with 0 down payment. And this is the big cherry on top with the icing and the sprinkles, and put whatever you want on here. The banks allow these negotiated seller contributions not only to be paid toward closing costs, but are also used to pay off liabilities like credit cards and auto loans that show up on the credit report. This increases the residual income and lowers the debt to income ratio, potentially turning a denied application into an approval. Now, you tell me if the VA loan option is the best option for our service members. Well, wait, there's more, and this is not an infomercial. This is a lower risk for the banks to make a VA loan. Why? Since the VA guarantees the top 25% of the loan, meaning the VA will cut a check to the lender with no questions asked if a VA loan goes into foreclosure. Plus, the bank takes back the home in this unfortunate incident and can sell it on the open market for the opportunity for the bank to regain most, if not all, of their investment. Now, with this guarantee from the VA, the banks can have more relaxed lending when you compare them to FHA financing and conventional financing. Now, does this loan do more bad than good? Comment below and let me know what you think, because I'm convinced that this has to be a prank. Like it or don't like it, these are the facts, and the guidelines are public knowledge and are listed in the VA Lender's Handbook, Pamphlet 26-7. Always know where to fact find and make sure that you get your own peace of mind. If you like this video, please comment below, and big shout out to my friend and retired Sergeant Major of the U.S. Marine Corps, Mr. Calvin and Miss Tina. You guys take care. Thanks for stopping by.